In 1976, a man launched a financial product that the investment industry called un-American. One prominent rival said it was a sure path to mediocrity. Another described it as Bogle's Folly. After the man who created it, the product was the index fund, and the people calling it mediocre were the ones who stood to lose the most if it succeeded. Today, index funds hold trillions of dollars and are used by more ordinary investors than any other product in history. Tonight, we are going to trace how a simple, almost boring idea quietly revolutionized the way the world invests, and why the people who fought hardest against it were, in a way, proving its point by doing so. There is something almost poetically appropriate about the nature of the opposition the index fund faced. The people arguing most vociferously that investors deserved better than average were the very people whose own ability to deliver better than average, reliably, over time, at a cost that left any advantage for the investor, was precisely what was in question. Their confidence was not evidence. Their credentials were not evidence. Their track records, as the data would increasingly make clear, were, for most of them, insufficient evidence of anything beyond normal variation in outcomes. The argument that active management was better than indexing rested ultimately on a claim about what skilled professionals could achieve that the evidence increasingly refused to support. And the index fund, sitting quietly with its tiny expense ratio and its mechanical market tracking, simply continued to accumulate the evidence against them, year after year, decade after decade. Because what the resistors could not say, and what the evidence would eventually force the world to confront, was that the very thing they were selling, the confident promise of expert returns, was something that most of them, most of the time, were not actually delivering. The fight against the index fund was not primarily an intellectual disagreement about efficient markets and statistical evidence. It was a fight about money, and about whose money, and about who had the right to take a fee for managing it. That dimension of the story, the commercial rather than the intellectual, is as important to understanding why the index fund's triumph took as long as it did as anything in the academic literature. Because here is what makes the index fund genuinely interesting, beyond the financial returns and the industry disruption. At its heart, it is a philosophical claim about the nature of markets and human knowledge, a claim that most professionals in the field were deeply invested in denying, and that decades of data have, with striking consistency, confirmed. Understanding the index fund is not just understanding an investment vehicle. It is understanding something real and somewhat humbling about the limits of expertise, the behavior of markets, and the particular kind of wisdom that comes from knowing what you do not know. But let us start somewhere closer, right here, in the world you live in, at this moment. Let us begin with the simplest possible description of what an index fund actually is, and then slowly add the layers that make it genuinely interesting. An index fund is an investment vehicle that holds a collection of assets, typically stocks, designed to mirror the composition and performance of a specific market index, such as the S&P 500, which tracks the 500 largest publicly traded companies in the United States. Rather than employing analysts and portfolio managers to select which specific companies to invest in, an index fund simply holds all, or a representative sample, of the companies in its target index, in proportion to their respective sizes, and does, essentially, nothing further. When companies in the index grow, the fund grows with them. When companies shrink or are removed from the index, the fund adjusts accordingly. The result is a portfolio that before costs performs exactly in line with the market it tracks because it is, in a meaningful sense, the market. It is also worth understanding a little more concretely how the proportions work, because this weighting methodology is central to understanding both what index funds do and some of the criticisms that have been made of them. Most broad stock market index funds use what is called market capitalization weighting, meaning each company is held in proportion to its total market value, the number of its shares outstanding multiplied by the current price of each share. A company worth 10 times as much as another will therefore represent 10 times as large a share of the portfolio. This has an important, somewhat counterintuitive implication. The larger and more expensive a company's stock becomes relative to the rest of the market, the more of it an index fund automatically holds. The index fund does not make any judgment about whether a company's price is justified by its underlying business. It simply holds whatever the market says each company is worth, in whatever proportion the market assigns. This characteristic means that if a particular group of companies, say technology companies in the late 1990s or in the 2020s, comes to represent an unusually large share of the total market's value, an index fund will hold an unusually large share of those companies, not because an analyst has decided they are the best investments, but simply because other investors have collectively bid up their prices. Critics of market cap-weighted indexing sometimes make exactly this point, arguing that it leads index funds to buy more of what has already become expensive and less of what remains cheap, an apparently backwards investment logic. Defenders respond that market prices reflect collective information and judgment, that there is no reliable way to know in advance whether a high-priced company is overvalued or simply appropriately valued, given its genuine prospects, and that any systematic attempt to deviate from market weights introduces active management decisions whose cost and reliability are subject to exactly the same scrutiny as any other active approach. This is one of the more intellectually interesting fault lines in the indexing world, not the debate between indexing and active management, which the evidence has largely settled in most market segments, but the debate within indexing itself about the optimal way to construct a passive portfolio, whether to weight by market capitalization, by earnings, by dividends, by equal weights across all companies, or by some combination of factors. Each approach has its defenders and its critics. Each has a body of supporting evidence and a body of critique, and each represents a genuinely different stance on what information about future returns is already contained in current prices, and what information might still be extracted by constructing an index differently. The fundamental argument in favor of market cap weighting, despite its counterintuitive feature of buying more of whatever has already become expensive, is essentially a statement of intellectual humility. Market prices, in aggregate, reflect the collective judgments of an enormous number of informed participants, and there is no reliable way for any single investor or any single index construction methodology to systematically improve on this collective judgment. Deviating from market weights means making an active bet that the market's current valuations are systematically wrong in a predictable direction, which is precisely the kind of claim that the efficient market hypothesis and the decades of evidence on active management performance suggest should be held with extreme caution. From this perspective, the market cap weight is not a naive default, but a principled acknowledgement that the market price is, in the absence of compelling evidence to the contrary, the best available estimate of a company's value. The debate about this question is likely to remain unresolved, and the honest answer is that different investors with different time horizons, different risk tolerances, and different views about the persistence of documented factor premiums may reasonably reach different conclusions about the appropriate weighting methodology for their own portfolios. What all of these approaches share, however, is the fundamental commitment to low costs and systematic implementation that distinguishes the entire family of passive investing from the active management it largely replaced. To appreciate how radical this was, it helps to understand what the investment landscape looked like before it existed. By the 1970s, the mutual fund industry had been operating for several decades as the primary vehicle through which ordinary Americans could access professionally managed investments. The first modern mutual fund in the United States, the Massachusetts Investors Trust, had been launched in 1924. And by the post-war period, the industry had grown into a substantial and confident establishment with its own professional culture, its own mythology of expert stock pickers, and its own considerable economic interest in persuading investors that skilled active management was worth paying for. The industry had developed what its critics would later call the performance chase, a marketing dynamic in which funds that had recently performed well received substantial publicity and new investor money, while funds that had underperformed quietly faded or were merged into their better-performing siblings. This survivorship, the tendency for only the successful funds to remain visible in the historical record, meant that the industry's track record looked considerably better in retrospect than it had actually been for investors living through it in real time. A new investor looking at the available mutual funds in any given year saw a set of funds that had, by definition, survived, and whose visible recent returns therefore looked relatively good, without any easy way to see the full population of funds that had existed in earlier years, including the many that had been closed or merged because their returns were too poor to attract continued investor attention. The premise of the industry was essentially uniform. Skilled portfolio managers, employing teams of analysts, could study individual companies, identify which ones were undervalued or had superior prospects, construct portfolios of these identified winners, and in doing so, deliver returns to investors that exceeded what the market as a whole delivered. Investors paid for this expertise through annual management fees, and the industry's sales materials, marketing materials, and the confident bearing of its practitioners all reinforced the same narrative. Expertise mattered, skill existed, and paying for it was rational. The industry had grown very comfortable with this narrative by the time Bogle launched his product, and for understandable reasons. Professional investment management is genuinely difficult work, requiring real knowledge and sophisticated analysis. The existence of people who know a great deal about financial markets and individual companies is not in question. The question the academic research had begun to raise, and that the index fund's creation embodied, was different. Not whether skilled analysis was possible, but whether it was reliably possible at scale, over time, in a market full of other people also trying to do the same thing at a cost that left anything over for the investor. This sounds almost embarrassingly simple, which is part of why it was so fiercely resisted when it first appeared. The investment industry had built itself around the premise that skilled professionals could, through research, analysis, and judgment, identify which investments would outperform the market, and that investors should pay for this skill. The index fund challenged this premise directly, offering an alternative built on the opposite assumption that consistently identifying winners in advance is essentially impossible, and that investors are better served by capturing the full return of the market net of the lowest possible costs than by paying for the attempt to do better. The fee structure that distinguishes index funds from actively managed funds is not a minor footnote. It is central to the entire argument. An actively managed mutual fund typically charges an annual fee, called an expense ratio, that might range from 0.5% to well over 1% of the total assets invested. with some funds charging considerably more when sales commissions and other loads are included. This fee is charged regardless of whether the fund outperforms the market, underperforms it, or simply matches it. An index fund, by contrast, requires very little active management, since it is simply tracking a predetermined list of holdings and, consequently, charges a tiny fraction of what an actively managed fund charges. In many cases, just a few hundredths of 1% per year. The difference in cost, compounded over decades, amounts to a genuinely significant sum, worth understanding concretely. Imagine two investors both putting away the same amount of money each month for 30 years, both earning the same underlying investment return before fees. The only difference is that one pays an annual expense ratio of 1% and the other pays an annual expense ratio of 0.1%, a difference typical of a middling actively managed fund versus a low-cost index fund. At a typical historical equity return, the investor paying the higher fee will have accumulated a portfolio worth considerably less than the investor paying the lower fee over that 30-year period, with the gap representing real money that went to the fund company rather than to the investor's retirement. This is the mathematical foundation of the index fund argument, and it is one that holds regardless of whether active managers are skilled or not, since even a skilled manager needs to overcome their own cost disadvantage before they can begin delivering any net benefit to investors. Bogle was fond of saying that in investing, you get what you do not pay for, meaning that costs are the one thing an investor can control with certainty, and that controlling them precisely is the single most reliable way to improve long-term outcomes. The statement sounds almost tautological, which is part of why it is so often underappreciated. But the mathematics are real, and the gap they describe is fully concrete in the final portfolio balance of any investor who has held a high-cost fund for many decades. There is a second, equally important component of the index fund's cost advantage worth naming, one that is often overlooked: taxes. When an actively managed fund buys and sells stocks throughout the year, as most of them do, those trades generate taxable events for investors holding the fund in taxable accounts. An index fund, because it buys and holds its entire index with very little trading, generates far fewer taxable events, meaning investors keep more of their returns rather than paying taxes on capital gains that are realized by the manager's trading activity. This tax efficiency compounds over time in much the same way that the expense ratio advantage does, adding another layer to the total cost advantage of the passive approach. The range of things that can be indexed has also expanded considerably since Bogle's original S&P 500 fund. Investors can now access index funds tracking the total U.S. stock market, international stocks across developed economies, emerging market stocks, specific sectors and industries, bonds of various maturities and credit qualities, real estate, commodities, and combinations of multiple asset classes across a single fund. The Total Return Bond Market Index Fund, tracking the broad universe of investment-grade bonds, has become a standard complement to equity index funds in many investors' portfolios, providing exposure to fixed income at similarly low cost. This expansion means that investors can now, in principle, hold a highly diversified portfolio spanning the entire investable world at a total annual cost of a fraction of a percent, something that would have been impossible for most individual investors at any cost just a few decades ago. The international dimension of this expansion is worth particular attention, since one of the more common concerns about indexing is the question of whether owning the entire U.S. market provides sufficient diversification, or whether investors should also hold international stocks? The answer that most financial economists reach is that international diversification genuinely reduces risk, since the stock markets of different countries do not move in perfect lockstep with one another. And holding a globally diversified portfolio captures the growth of the world economy rather than just one country's economy. An investor who holds only U.S. index funds is making a concentrated bet on the continued economic dominance of a single country, however large and successful that country has historically been. Global index funds, which hold stocks from both U.S. and international markets in proportion to their relative sizes, offer an alternative that requires no prediction about which country or region will outperform over the relevant time horizon. There is a second, equally important component of the index fund's cost advantage worth naming, one that is often overlooked: taxes. When an actively managed fund buys and sells stocks throughout the year, as most of them do, those trades generate taxable events for investors holding the fund in taxable accounts. An index fund, because it buys and holds its entire index with very little trading, generates far fewer taxable events, meaning investors keep more of their returns rather than paying taxes on capital gains that are realized by the manager's trading activity. This tax efficiency compounds over time in much the same way that the expense ratio advantage does, adding another layer to the total cost advantage of the passive approach. Studies examining the after-tax returns of actively managed funds versus comparable index funds consistently find that the tax advantage of index funds makes the total gap between passive and active returns even larger than the pre-tax comparison suggests, particularly for investors holding funds in taxable brokerage accounts rather than tax-advantaged retirement accounts. But to understand why this simple, mathematically compelling idea took as long as it did to reach ordinary investors, and why it met with such sustained resistance when it finally did, we need to go back. Not because history is interesting for its own sake, though it very often is, but because the present on its own does not fully make sense without it. The story of the index fund begins, in an important sense, with a question about what markets actually are and what it means for a market to be efficient. The efficient market hypothesis, developed most prominently by the economist Eugene Fama at the University of Chicago in the 1960s and 1970s, held that financial markets are, in an important sense, very good at incorporating available information into prices. If a piece of information, a company's earnings report, a change in interest rates, a geopolitical development, becomes publicly available, large numbers of investors will immediately analyze that information and act on it, buying or selling accordingly, until the price has adjusted to reflect the new information. This rapid, collective process of adjustment means that at any given moment, the price of a stock already reflects everything that is publicly known about the company it represents, and that no investor can gain a systematic advantage by analyzing publicly available information, since every other informed investor is doing the same thing and prices have already moved to account for it. The efficient market hypothesis has been debated, qualified, and criticized since it was first proposed, and the full picture it presents is considerably more nuanced than this brief summary suggests. Fama himself articulated the hypothesis in 3 distinct versions of increasing strength. The weak form holds that past price movements cannot be used to predict future price movements, meaning that technical analysis of price charts is essentially futile. The semi-strong form holds that all publicly available information is already reflected in prices, meaning that careful fundamental analysis of company reports, earnings releases, and publicly available news is also unlikely to generate consistently above-market returns, because any publicly available insight will already have been traded on by others. The strong form holds that even private, Insider information is already incorporated in prices, a claim most researchers and regulators have rejected. Given the documented ability of genuine insiders to trade profitably on non-public information, most serious economists accept some version of the semi-strong form, while acknowledging the strong form is an overstatement. And the debate about exactly how efficient markets are in various segments and circumstances has remained genuinely active ever since. But its core insight that markets are genuinely difficult to beat consistently over time because prices reflect available information with remarkable speed, laid the intellectual groundwork for the index fund's eventual emergence. If you cannot gain an advantage through research and analysis, because the research and analysis of thousands of other investors has already moved prices, then the rational strategy is simply to own the market itself at the lowest possible cost, rather than paying for the attempt to outperform it. This idea was understood theoretically before anyone had actually built a product to implement it for ordinary investors, and the intellectual groundwork had been built up slowly, over decades, by researchers who were often working against the current of industry orthodoxy. The earliest significant empirical work predating Fama's theoretical framework came from an unlikely source. Alfred Cowles III was a wealthy Chicago businessman and amateur statistician who became interested in the question of investment forecasting after losing money following recommendations in financial newsletters and stock market advisory services. His frustration was not with the losses themselves, which any investor might accept as ordinary market risk, but with the specific discovery that the advisors he had paid for guidance had, as a group, done no better than he might have done by random selection. He founded the Cowles Commission for Research in Economics in 1932, partly to pursue exactly this kind of careful, empirical testing of the claims financial professionals routinely made about their own ability. His early findings, published in 1933 under the title, "Can Stock Market Forecasters Forecast?", examined thousands of specific forecasts from various investment advisors and reached the conclusion that the evidence, taken as a whole, did not reveal any forecasting ability. The paper is sometimes cited as one of the founding documents of financial economics as an empirical discipline, because it treated the question of investment performance as something that could actually be tested with data, rather than simply asserted based on credentials and confidence. Through the 1950s and 1960s, the academic case continued to build. A Princeton economist named Burton Malkiel was developing the argument that would eventually become his famous 1973 book, making the pointed claim that the movement of stock prices was essentially random in the short term, and that a blindfolded monkey throwing darts at a newspaper stock listings would, on average, do as well as a professional portfolio manager. This argument was deliberately provocative, and it provoked exactly the response its author anticipated from an industry that had invested heavily in the opposite claim. But the underlying data behind the provocation was serious and carefully gathered, and Malkiel's book became one of the most influential popular finance books of the 20th century, eventually going through more than a dozen editions and introducing the indexing argument to an audience far beyond the academic finance community. Academic research through the 1960s and 1970s had begun to document, with increasing rigor, the uncomfortable finding that most professional fund managers did not, in fact, consistently outperform the market, and that when the cost of their fees was factored in, the majority of them were actually delivering less to their investors than a passive, market-matching strategy would have. A Wells Fargo Bank research team actually built the first institutional index fund in 1971, several years before Bogle's retail product, tracking the New York Stock Exchange Composite Index for a single pension fund client. This earlier effort remained institutional and largely invisible to ordinary investors. The intellectual case had been made. The products had been built in limited form. What was still missing was someone willing to take the argument to ordinary investors directly, in the form of a product they could actually access, and willing to sustain that product through the years of derision and thin asset flows that, as it turned out, would be required before the idea gained genuine traction. This is where John Bogle enters the story. Bogle was an unusual figure in the investment industry, a man whose personality combined deep idealism about the purpose of investing with an almost combative willingness to say in public what others privately acknowledged but preferred not to discuss. Born in 1929 into a family that lost most of its wealth in the Depression, Bogle had a personal understanding of what financial devastation meant for ordinary people, and a resulting conviction that the investment industry existed, or should exist, primarily to serve the interests of investors rather than the interests of fund managers and financial companies. Bogle's path to the index fund ran through a remarkable piece of biographical irony. He wrote his senior thesis at Princeton in 1951, arguing that most mutual funds could not and did not outperform the market, and that the costs of active management fell disproportionately on ordinary investors who could least afford them. The thesis drew on a careful reading of available data on mutual fund performance, and its conclusions were pointed. The industry was not delivering what it promised for the ordinary investor, and the structural reasons why this was the case were not incidental, but built into the incentive architecture of the industry itself. He then spent the next 2 decades working within the very industry he had critiqued, rising to lead Wellington Management Company, one of the prominent mutual fund companies of the era. This is the irony worth noting. The man who would eventually disrupt the industry spent his formative professional years building expertise within it, and the insights that disruption required came not from the outside, but from having seen, at close range, exactly how the industry actually functioned and who it actually served. Bogle was fired from the leadership of Wellington Management in 1974, following a failed merger with a more aggressive, performance-oriented firm that Bogle had championed and that proved disastrous for investors. The professional humiliation of this dismissal, paradoxically, gave him the opportunity to build what he had long believed needed to exist. With the remnants of his position, he was permitted to establish a new company, Vanguard, to handle certain administrative functions for the Wellington funds, but was initially barred from operating an independent investment management operation. It was within these constraints, stripped of the ability to do what the rest of the industry did, that Bogle found the space for his most consequential idea. If Vanguard could not manage portfolios actively, what could it do? The answer was track and index, a purely mechanical function that required no active management judgment whatsoever, and that Bogle could therefore argue fell within his restricted mandate. The first index fund available to ordinary retail investors, initially called the First Index Investment Trust and later renamed the Vanguard 500 Index Fund, was launched in August 1976. The timing was not auspicious. Markets had been in a prolonged downturn, investor confidence was low, and the idea of intentionally capturing average market returns struck most of the financial world as bizarre at best and irresponsible at worst. Bogle founded Vanguard with an additional structural innovation that was, in its own way, as significant as the index fund itself. Most investment companies are owned by outside shareholders or by the investment managers themselves, who profit when the company grows its fee revenues. The more assets a conventional fund company manages, the higher its fee revenues, and the higher its revenues, the more profitable it is for its owners. This creates a direct financial incentive to grow assets under management by attracting investor money, and a correspondingly weak incentive to lower fees, since lower fees reduce revenue. The company's interest in growing its own revenues is not necessarily aligned with the investor's interest in paying the lowest possible fees. And this misalignment sits at the heart of a great deal of what is wrong with the conventional active management industry. Vanguard was structured as a mutual company owned by the funds themselves, which in turn were owned by the investors in those funds, in theory and largely in practice. This meant that Vanguard had no incentive to charge investors more than the cost of running the operation, since any profits would simply return to the investors through lower costs. When Vanguard operates more efficiently and generates a surplus, that surplus flows back to investors in the form of reduced expense ratios, rather than to outside shareholders. This is genuinely unusual, and it is what has allowed Vanguard to consistently lower its expense ratios over time, as it has grown larger and achieved scale economies that a for-profit fund company would have been tempted to keep as profit rather than return to investors. This structural difference gave Bogle the platform from which to launch his index fund, and it is what still distinguishes Vanguard from most of its competitors today, creating an alignment of interests between the company and its investors that is genuinely unusual in the financial services industry. The reaction from the rest of the industry was swift and largely unfavorable. The fund was derided as Bogle's Folly. It was described as settling for mediocrity, as un-American, as an abdication of the entrepreneurial spirit. Competitors ran advertisements suggesting that investors deserve better than the average. Fidelity's chairman reportedly called it a guaranteed recipe for mediocrity. One Wall Street figure called it a sure path to a guaranteed outcome of average, which he clearly meant as a condemnation. The fund initially struggled to raise assets, drawing in only a fraction of what Bogle had hoped to gather in its first offering. The goal had been to raise over $100 million. The actual amount raised was closer to $11 million, a humbling fraction of the target, and far below what the fund needed to be operationally efficient at the scale Bogle had envisioned. What is worth noting about the industry reaction is not just the hostility, which was predictable given the financial interests at stake, but the specific nature of the arguments made. The people most opposed to the index fund were, almost without exception, the people who stood to lose the most financially if it succeeded. The fund managers whose fees would be undercut, the brokers who earned commissions on actively managed fund sales, the financial press that depended on active management for its content, all the professionals whose livelihoods depended on the premise that skilled stock selection had value. Their arguments against the index fund were not disinterested evaluations of the evidence. They were defenses of a business model, dressed up in the language of investor advocacy. Bogle's great contribution was to recognize this, to name it clearly, and to persist against the institutional weight of these interests until the data made his case in a way that could no longer be denied. For several years, the product that would eventually change everything barely survived. Bogle considered scaling back the concept or restructuring it. The intellectual case for indexing was clear to those who had read the academic literature carefully, but translating that intellectual case into investor confidence against a well-funded industry narrative insisting that skilled active management was worth the cost proved considerably harder than building the product itself. The industry had sales forces, advertising budgets, distribution networks, and decades of accumulated trust. Vanguard had a compelling idea and the patience to wait for the data to do its persuading. The arguments made against index funds in their early years are worth knowing in some detail because they are the same arguments that have been made in modified forms ever since. And because understanding why they fail illuminates exactly what makes the indexing case so strong. The most common objection was that index funds guaranteed mediocrity. By definition, an index fund could only match the market, never beat it. This objection is true in a narrow, technical sense. An index fund cannot, by construction, outperform the market before costs. But it misses what the actual alternative is. The relevant comparison is not between an index fund and a hypothetically superior active manager. It is between an index fund and the actual population of active managers that investors encounter in the real world, most of whom, most of the time, and most especially over long periods, after costs, do not outperform the index. Choosing between a certain market return and a range of possible active manager outcomes that cluster, on average, below the market return after costs is a different calculation than the simple mediocrity argument suggests. A second objection made more quietly within the industry and more explicitly by academic critics was that if everyone indexed, markets would become less efficient. This objection pointed to a genuine theoretical concern, which we will return to shortly, but it ignored the observable reality that active management had never been anywhere near universally successful, even when it was essentially the only option available, and that the scale of indexing required to meaningfully impair market efficiency was far larger than anything that existed or was likely to exist for many years. Let us bring together everything we have gathered so far, the mechanism from earlier, and the history we have just walked through, because this is the point where they finally lock together into something you can actually use to make sense of the news. The arc from Bogle's struggling $11 million fund in 1976 to a world in which index funds hold roughly half of all assets in the American equity market is one of the most remarkable transitions in the history of modern finance. And it did not happen quickly or smoothly. For the first decade of Vanguard's existence, the indexing idea remained a marginal curiosity, something acknowledged as theoretically interesting by academics, but largely ignored by the professional investment community and the investors who trusted it. Assets in the Vanguard 500 index fund grew slowly through the late 1970s and into the 1980s. As a small but growing community of individual investors who had read the academic literature or encountered Bogle's public arguments began to take the idea seriously. The fund's performance, which by definition matched the S&P 500 before costs and then delivered the S&P 500 minus its very small expense ratio to investors, was unremarkable in good market years and unremarkable in bad ones, which was precisely the point, but which offered no compelling narrative to attract investor attention in a financial media landscape that ran on stories of exceptional returns and market-beating insight. The 1980s and early 1990s proved to be a period of strong stock market performance, which is the environment in which the active management industry tends to look most convincing, since rising markets lift all boats and make it easier for active managers to produce absolute returns that feel impressive even when they trail the index on a relative basis. The bull market of the 1980s drew investor attention toward the exciting, the dynamic, the actively managed. And yet, even in this environment, the data on active management underperformance continued to accumulate, and the number of investors paying attention to that data slowly and quietly grew. Several large institutional investors, including major pension funds and university endowments, began allocating portions of their portfolios to passive strategies in the 1980s, driven by the cost arithmetic and the growing weight of evidence, and their adoption helped establish the intellectual credibility of indexing for a professional audience that had been resistant to the retail version of the argument. The gradual shift from active to passive management that has occurred over the past several decades represents one of the most significant structural changes in the history of modern finance. And it is still very much in progress. In the early years of index investing, passive funds held only a tiny fraction of the total assets under management in the financial industry. Through the 1980s and 1990s, as the evidence continued to accumulate that active management was not delivering on its promise for most investors, flows into index funds grew steadily, and Vanguard, which had struggled in its early years, grew into one of the largest financial institutions in the world. A parallel development accelerated this shift considerably: the rise of the defined contribution retirement plan, and specifically the 401k plan, which became the dominant vehicle for workplace retirement savings in the United States following legislative changes in the early 1980s. Under the older defined benefit pension system, an employer managed a pool of money on behalf of employees and promised them a specific retirement income regardless of investment results. Under the 401k system, the employee bears the investment risk directly and must make their own investment decisions within the plan's menu of options. This change, affecting tens of millions of ordinary workers who had no particular investment expertise or interest, created an enormous new population of people who needed to make investment decisions and were often bewildered by the choices available to them. The contrast between these two systems is worth understanding concretely because it illustrates how dramatically the institutional framework of retirement saving changed, and how that change created the need for the kind of simple, low-cost solution that index funds provide. Under the old defined benefit system, an employee's retirement income was essentially a promise from their employer, backed by a pool of professionally managed investments that the employee never needed to think about or understand. The investment complexity was entirely hidden from the employee's view. Under the defined contribution system, that complexity became the employee's own responsibility, along with all the associated risk and all the associated decisions. The average worker, trained in nursing or engineering or retail management, suddenly needed to evaluate mutual fund expense ratios, compare asset allocation strategies, and decide how to rebalance a portfolio as market conditions changed, tasks for which nothing in their education or work experience had prepared them. For this population, the simplicity of an index fund, with its low-cost, broad diversification and absence of any need for ongoing manager evaluation, turned out to have practical advantages that its academic advocates had not initially emphasized as prominently as the theoretical case for efficiency. An ordinary worker contributing to a 401k plan who selects a single low-cost total market index fund and holds it through their working career needs to make essentially no subsequent investment decisions. The fund does the rest, automatically at a cost so low it is barely perceptible, capturing the full return of the market over whatever time horizon the worker happens to hold it. This simplicity is not merely a convenience for an investor who is likely to make poor timing decisions when presented with too many options and too much confusing information. The forced simplicity of a single index fund is itself a protective feature, preventing the kind of intervention that the behavior gap research shows consistently costs investors returns. The rise of exchange-traded funds, or ETFs, beginning in the early 1990s and accelerating dramatically through the 2000s, made index investing even more accessible and even cheaper. The first broad market ETF, launched in 1993 and commonly called the Spider, tracked the S&P 500 and could be bought and sold throughout the trading day like an individual stock, with no minimum investment requirements and expense ratios even lower than Bogle's original fund. The ETF structure also offered particular tax efficiency advantages over traditional mutual funds, making it more attractive for investors holding assets in taxable accounts. The proliferation of ETFs through the 2000s and 2010s brought index investing to an entirely new generation of investors, including younger investors using mobile apps and brokerage platforms that had made individual investment even more accessible than it had ever been. By the early 2020s, passive funds had grown to hold roughly half of all assets in U.S. equity mutual funds and ETFs, a genuinely remarkable shift from essentially zero a few decades earlier. The companies whose shares made up the major indices, which had once been almost entirely owned by active institutional investors making individual stock selections, were now substantially owned by index funds that simply held everything. This shift had consequences for market structure and corporate governance that researchers are still working to understand fully. When the largest shareholders of most major companies are index funds that own every company in an industry, the traditional competitive pressures that shareholders might exert on management through the threat of selling a poorly performing company's shares are altered in ways that are genuinely novel. An active investor who believes a management team is performing poorly can sell the stock, putting downward pressure on the price and signaling their displeasure in the traditional way. An index fund that is required to hold every company in its index cannot do this, since selling one company in the index would require the fund to deviate from its mandate. Index funds instead must express their views on management through proxy voting, engaging with company management directly through a form of shareholder oversight that operates through entirely different channels and with different incentives than the traditional market-based discipline of the threat of exit. The major index fund managers, particularly the three largest, which collectively hold enormous stakes in virtually every significant publicly traded company in the world, have developed substantial internal teams devoted to corporate governance and proxy voting specifically to fill this oversight function. Whether large index fund managers exercise this governance role effectively, whether their engagement with management across thousands of portfolio companies produces meaningful accountability, and whether the concentration of share ownership in the hands of a small number of very large asset management companies creates problematic alignments of interest, are all questions that researchers and regulators are actively wrestling with. Some consumer advocates have argued that the major index fund managers are too passive in their corporate governance engagement, unwilling to use the enormous voting power they collectively hold to challenge management decisions at the companies they own. Others have argued that they are increasingly too activist, using their voting power to advance social and political goals that may not reflect the views of all the underlying investors whose money they manage. Both criticisms cannot be simultaneously correct, but both reflect a genuine concern about how the governance function gets exercised in a world where the largest shareholders are passive investors by design. Some economists have also raised a more fundamental concern about what happens when a small number of very large asset managers own shares in every company in an industry simultaneously. The competitive dynamics between airlines or banks or pharmaceutical companies may be altered when the major shareholders of each competitor are the same handful of index fund managers who have an interest in the profitability of all the competitors simultaneously rather than in the success of any particular one. This concern, sometimes called the common ownership problem, is genuinely contested among economists, with some viewing it as a serious potential harm to competition and others arguing that the evidence for any actual effect on market behavior is too weak to draw strong conclusions. It is, however, one of the more novel and interesting consequences of the indexing revolution that Bogle launched in 1976 that neither he nor his critics anticipated in those early years when the fund was struggling to raise its first $11 million. There is a further note worth adding to the history of the indexing debate, because it provides one of the more vivid and well-documented tests of the active versus passive argument ever conducted. In 2007, the investor Warren Buffett, one of the most celebrated active investors in history, and himself a living exception to many of the generalizations the indexing argument makes about active management, made a public bet of $1 million against a prominent hedge fund manager, arguing that a simple S&P 500 index fund would outperform a selection of actively managed hedge funds over the following decade. Hedge funds represent active management at its most expensive and most exclusive. These are investment vehicles that typically charge both a substantial annual management fee and a share of any profits they generate, employ sophisticated strategies involving leverage and short selling, as well as ordinary stock selection, and are available only to wealthy investors who meet substantial minimum investment requirements. The hedge fund industry had for years presented itself as the pinnacle of sophisticated, skilled investment management, attracting some of the most talented analytical minds in finance and charging fees that reflected this self-assessed superiority. The bet Buffett proposed was an unusually direct test of whether that sophisticated management delivered results that justified its costs. Stripped of all the qualifications and caveats that normally surround comparisons between different investment strategies, the decade ended in 2017. The index fund won, and it was not close. The compounding of fees in the hedge fund portfolio, combined with the difficulty of generating genuine alpha in a market where many very smart people were all trying to do the same thing, produced a result that validated in a very public and memorable way the same conclusion that the academic literature had been reaching, less publicly and less memorably, for many decades. Buffett donated the winnings to charity. The lesson he drew from the experience, which he shared in his annual letter to shareholders shortly afterward, was the same lesson Bogle had been trying to teach since 1976. For most investors, most of the time, a low-cost index fund is not a compromise. It is the best available option. Buffett was particularly emphatic that when he and his wife are no longer alive, the instructions in his will direct that his wife's inheritance be invested in a low-cost S&P 500 index fund, a statement that carried rather more weight than most investment endorsements, given the source. The evidence that fueled this shift continued to accumulate. Study after study, conducted by academics, by financial regulators, by independent researchers with no stake in the outcome, found broadly the same result. Over periods of 10 years or more, the large majority of actively managed funds underperformed their respective benchmark indices. After costs, S&P Global publishes a report called SPIVA, the S&P Indices versus Active Report, on a semi-annual basis, tracking the performance of active managers across many different categories of funds against their relevant index benchmarks. The findings have been remarkably consistent across years and across fund categories. The percentage of active managers that underperform their benchmark rises with the time horizon, and over periods of 15 or 20 years, the underperformance is nearly universal in most categories. In a typical year, the SPIVA report will find that somewhere between 60 and 80% of active large-cap equity funds underperformed their benchmark index over the previous 10-year period, and this figure climbs higher still over 15-year and 20-year horizons. The percentage that underperformed tended to rise with the time horizon because the compounding of small annual cost differences produced increasingly large gaps over time, and because even those managers who genuinely outperformed for a few years tended to revert toward the average over longer periods. There is also a survivorship bias problem. that makes even the available data on active manager performance somewhat optimistic relative to what an investor actually would have experienced. Funds that perform poorly are frequently merged into better performing funds, or simply closed, which means that the historical record of fund performance available for analysis excludes the worst performers. When researchers attempt to include the performance of funds that no longer exist, the picture for active management becomes even less favorable than the data on surviving funds alone suggests, sometimes substantially so. An investor who had selected what appeared to be a reasonable active fund 10 or 15 years ago faces a meaningful probability that the fund they selected no longer exists in its original form, having been merged or closed after poor performance, and would need to have selected a replacement at some point during that period, potentially at a further cost disadvantage. The scale of this problem is worth appreciating concretely. Studies examining the total universe of mutual funds at a given starting date have found that over a 15-year period, a substantial fraction of those funds no longer exist at the end of a period. They were merged, closed, or renamed into something different, almost invariably because of poor relative performance. The funds that survive tend to be the ones that perform best, and those are the ones whose long-term track records are visible to a prospective investor. An investor looking at the historical performance of currently available funds is therefore looking at a selection that has been filtered for past success, which creates a misleading picture of the odds that any future randomly selected fund will outperform. The average performance of currently existing funds looks meaningfully better than the average performance of all the funds that were available at any past starting date, because the underperforming funds have quietly disappeared from the dataset. The handful of managers who did outperform consistently over long periods were small enough in number that it was genuinely difficult to distinguish, before the fact, whether their outperformance reflected skill or luck, since a small number of managers will outperform purely by chance over any given period in a large enough industry. This is the same point Cowles had made in the 1930s, and that Fama had made with more mathematical rigor in the 1960s. Given a large enough population of active managers making independent decisions, some percentage will outperform the market for any given period purely by chance. And the challenge is to determine whether a manager who has outperformed for 5 or 10 years falls into the skill category or the luck category before you commit your savings to following their future decisions. The research on this question is sobering, and the answer, broadly, is that distinguishing the two in advance is considerably harder than the confident narratives that surround successful fund managers typically suggest. This last point deserves a moment of careful attention because it is the one that the industry's defenders find most contentious. Surely some active managers are genuinely skilled, and their sustained outperformance reflects real analytical ability rather than random chance. This may well be true. The problem, from an ordinary investor's perspective, is identifying those managers in advance, before they have outperformed, rather than in retrospect, after they already have. There is also a deeper mathematical argument that the economist William Sharpe made in an influential 1991 paper, which is worth understanding because it shows that the underperformance of active management in aggregate is not an empirical finding that might change over time, but a mathematical necessity. The total return of the stock market is the weighted average return of all investors in that market. Passive investors, by definition, earn the market return before costs. Active investors, in aggregate, must also earn the market return before costs, since they collectively hold the same market that the passive investors hold. After costs, however, active investors must earn less than the market return because their costs are higher. This means that the average active investor must underperform the average passive investor, not as a historical observation that might change, but as a logical consequence of the arithmetic of investing. Sharpe called this the arithmetic of active management, and it is worth pausing on because it reframes the entire debate. The question is not whether active management can beat the index, as if this were an empirical question that might go either way, depending on who you pick or which period you examine. The question is whether any particular investor can identify in advance which active managers will be among the minority who beat the index by enough to cover their costs, in a world where the average active manager must, by the arithmetic, underperform. This is a much harder problem than simply finding a good manager, because good past performance does not reliably predict future performance. And because the minority of managers who do consistently outperform must be exactly balanced by a corresponding minority who consistently underperform by equal amounts, making the identification of future winners from the current pool of managers a genuinely difficult and largely unreliable exercise. Some active managers will outperform, of course, but they must be exactly offset by other active managers who underperform by an equal and opposite amount. The question for any individual investor is merely whether they can identify, in advance, which side of this ledger a particular manager will fall on, by enough to cover the costs, and the evidence on this specific question is consistently unfavorable. The research on this question is sobering. Past outperformance has proven to be a poor predictor of future outperformance, once appropriate adjustments are made for the level of market risk the fund took on. Managers who outperform for a few years attract new money, which can itself change the dynamics of their strategy and make further outperformance harder to sustain. And the costs of the search for a skilled active manager, which involves either significant research time or payment for financial advice, add to the cost disadvantage relative to simply owning the index. There is genuine ongoing debate among researchers and market participants about several aspects of this picture, worth being honest about rather than pretending the field is more settled than it truly is. One area of genuine disagreement concerns market efficiency in different market segments. The efficient market hypothesis, in its strongest forms, has been challenged by a substantial body of research documenting persistent patterns in financial markets that a truly efficient market should not exhibit, patterns sometimes called anomalies or factors, such as the tendency of smaller companies to outperform larger ones over time, or the tendency of lower-priced companies relative to their earnings to outperform more expensive ones, or the tendency of stocks that have performed well recently to continue performing well in the short run. Whether these patterns represent genuine, exploitable inefficiencies, or simply additional sources of risk that investors are compensated for bearing, or anomalies that disappear once they are widely recognized and traded upon, is actively contested. This debate has spawned an entire generation of what practitioners call factor investing, or smart beta, index-like investment vehicles that systematically tilt their portfolios toward these documented patterns rather than simply owning the whole market. The research underlying these approaches has a distinguished academic pedigree, including work by Fama himself, who, with his colleague Kenneth French, published an influential 1992 paper documenting two additional factors beyond simple market risk: the size premium, meaning smaller companies had historically outperformed larger ones, and the value premium, meaning companies trading at lower prices relative to their book values had historically outperformed more expensive ones. This paper, known in the finance literature as the Fama-French three-factor model, represented Fama's own careful engagement with the anomalies that challenged the strongest versions of efficient market theory. And it opened the door to a research tradition that has identified numerous additional factors in the decades since, including momentum, profitability, investment style, and others. The intellectual honesty of this development is worth pausing on. Fama, whose own theoretical framework had provided much of the intellectual foundation for the case against active management, was also one of the researchers who documented the most compelling evidence that certain systematic tilts in portfolio construction appeared to deliver additional returns that a simple market portfolio could not explain. Rather than dismissing these findings as anomalies to be explained away, he incorporated them into a richer model of how markets work, acknowledging that the simple, single-factor version of the efficient market story was incomplete. This willingness to let the data modify the theory, rather than forcing the data to fit the theory, is exactly what makes the scientific study of financial markets progressive rather than static. And it is the same spirit that animated Cowles's reluctant documentation of his uncomfortable findings 60 years earlier. Whether these documented factor returns represent genuine, persistent sources of additional return, or simply rewards for bearing additional forms of risk, whether they will persist now that they are widely known and widely exploited, and how much of the historical factor premium will be available to investors who tilt toward these factors in their own portfolios, are all genuinely open questions, with serious researchers holding meaningfully different views based on the same underlying evidence. These questions are likely to be debated for decades more, without any final resolution that satisfies everyone. What they share, however, is the fundamental commitment to empirical evidence, to building investment strategies that respond to what the data actually shows, rather than what any particular narrative claims, that connects them to the tradition Cowles and Fama and Bogle, each, in their own way, exemplified. A value index fund, for instance, might own only the stocks trading at the lowest prices relative to their earnings, rather than all stocks in proportion to their market capitalization. A small-cap index fund might own only the smaller companies in a market. A momentum index fund might systematically hold the stocks that have risen most over the previous year, a strategy that research has found to have positive expected returns, despite running counter to the intuition of most investors who associate recent winners with things that have become too expensive. These approaches retain much of the cost and simplicity advantage of indexing while attempting to capture some of the additional return that the research suggests may be available from systematic exposure to these factors. They have attracted significant assets and significant academic interest, while also generating genuine disagreement about whether the historically observed factor returns will persist now that they are widely known and widely exploited. Some researchers argue that once a factor is published and widely known, the informed investor community will trade on it until it disappears. The very process that makes markets efficient, eroding the anomaly as fast as it becomes actionable. Others argue that the factors reflect genuine and persistent risk premiums that investors are compensated for bearing, which would make them durable rather than fleeting. This debate is ongoing and genuinely unresolved, and it underlies much of the strategic disagreement between different providers of index-like products in the marketplace today. There is also a genuine and somewhat philosophical concern that has grown more prominent as index funds have come to hold an increasingly large share of the market. If enough investors simply index, who is doing the work of analyzing companies and incorporating information into prices that makes the market efficient in the first place? The efficient market argument for indexing implicitly depends on there being enough active investors engaged in price discovery to keep prices roughly accurate. If passive investing grew to an extreme share of the market, it might, in theory, reduce the quality of price discovery and create opportunities for the active investors who remained. Some researchers argue, somewhat paradoxically, that the success of indexing depends on enough other investors continuing to practice active management to maintain the market efficiency that makes indexing attractive. This concern is genuine and taken seriously by thoughtful researchers, though the current evidence does not suggest that passive investing has yet grown to a scale that meaningfully impairs the quality of market prices. And the level of indexing that would create genuine problems remains both unknown and well above current levels. So what does all of this mean for us? Not for portfolio theorists debating efficiency and market structure, but for the quiet daily life that most of us are actually living, lying here in the dark, thinking about our own savings, our own retirement, our own uncertain financial future. It is worth pausing before we reach the practical implications to name a subtlety in the indexing argument that is sometimes glossed over in popular accounts. The case for index funds does not rest on the claim that no active manager is ever skilled, or that markets are perfectly efficient, or that analyzing companies is a useless exercise. It rests on the considerably more modest and considerably more defensible claim that the costs of active management are certain and substantial, that the benefits are uncertain and, for most managers, insufficient to offset those costs, and that for most ordinary investors, with limited time, limited expertise, and limited ability to identify the genuinely skilled managers in advance, the index fund represents the most reliable available path to capturing the returns that the market generates. Let us also address some of the specific anxieties that tend to gather around the idea of holding a simple index fund, particularly the anxiety about what happens during a market crash. An index fund holds everything in the market, which means that when the market falls, the index fund falls with it, fully and without cushion. An active manager might, in theory, anticipate a downturn, reduce their equity exposure, and protect their clients from the worst of the decline. This is true as a theoretical possibility, and this potential is part of what makes the active management pitch emotionally compelling, particularly to investors who have experienced a severe market downturn and felt its pain. The problem is that the evidence for active managers actually executing this kind of protective market timing successfully across market cycles is not encouraging. The research on market timing is, if anything, even bleaker than the research on stock selection. The evidence that active managers successfully reduce portfolio risk ahead of downturns while maintaining sufficient exposure to capture the recoveries that follow is very thin relative to the considerable costs and risks of attempting it. The index fund investor who accepts the full market drawdown does so in exchange for the full market recovery that follows. And historically, that patience has been rewarded. The active management investor who hopes their manager will protect them from the downturn faces the possibility that the manager will succeed, but also the considerably higher probability that the manager will either fail to anticipate the downturn or correctly reduce exposure, only to then miss the recovery, or charge enough in fees that any timing success is eroded by cost. The historical record of active management timing decisions reviewed across market cycles and multiple decades is not kind to the optimistic case. There is something worth naming directly, because it tends to get lost in the abstract discussion of averages and percentages and expense ratios. The choice between index investing and active investing is not just a mathematical question about expected returns. It is also a question about what you are actually trying to accomplish with your savings. Over what time horizon? With what tolerance for different kinds of uncertainty? A person who is genuinely well served by an active manager, who benefits from the ongoing relationship, the behavioral coaching, The comprehensive financial planning that a good advisor can provide alongside investment management may be getting real value that does not show up in the raw comparison of expense ratios. The indexing argument is most persuasive when it is applied to the pure investment management function in isolation. When it is applied to the full package of services that a genuinely good financial advisor provides, the comparison is more complex and more honest. So what does all of this mean for us? Not for portfolio theorists debating efficiency and market structure, but for the quiet daily life that most of us are actually living, lying here in the dark, thinking about our own savings, our own retirement, our own uncertain financial future. There is a natural question that tends to surface right about now, having walked through the efficient market hypothesis and John Bogle and decades of studies showing that most active managers underperform. If the case for index funds is this strong and the evidence this consistent, why does the active management industry still exist at such scale, drawing in literally trillions of dollars in fees every year from investors whose returns would, the evidence suggests, generally be better served by a passive approach? Why do so many intelligent, otherwise financially sophisticated people still choose actively managed funds? Part of the answer lies in the genuine, if narrow, cases where active management does add value. Not all investment markets are equally efficient. Markets for publicly traded large-cap stocks in the United States and other major economies, where information is widely available, analytical coverage is dense, and trading is highly liquid, are among the most efficient markets that exist, and it is in exactly these markets that the case for indexing is strongest. Markets for smaller, less analyzed companies, for companies in less developed economies where information quality is lower and analytical coverage is thinner, and for certain other asset classes that are less amenable to passive replication, are generally considered somewhat less efficient, meaning the case for skilled active management is somewhat stronger, even if still far from guaranteed. Some institutional investors, managing very large pools of capital with access to top investment talent and the ability to conduct genuine proprietary research, can and do generate meaningful returns above what a passive approach would deliver in some market segments. The honest version of the indexing argument acknowledges these nuances, rather than dismissing active management as uniformly futile across every context and every market. The answer is genuinely interesting, and it connects directly to the psychology of money we explored on another evening together. Humans find it deeply difficult to accept average outcomes, even when average is demonstrably better than what most people actually achieve through the attempt to do better than average. We are pattern-seeking creatures who look at a skilled-sounding manager with an impressive track record and want to believe that this time, with this particular person, we have found the exception. The knowledge that most such judgments have been wrong before does not fully extinguish the feeling that they might be right this time. Partly because the stories we tell ourselves about exceptional skill are vivid and emotionally compelling in ways that statistical abstractions about average outcomes are not. The story of the brilliant analyst who identified a company's potential before anyone else, did the work, made the call, and was proven right, is a genuinely compelling narrative. The story of an expense ratio compounding favorably over 30 years is a correct but considerably less cinematic way to describe a better investment outcome. In a market downturn, every investment in an index fund falls with the market, and there is nothing the investor can do to change this except wait. An investor who owns an actively managed fund can tell themselves that a skilled manager is actively working to navigate the conditions, making adjustments, finding opportunities, doing something. The index fund investor has no such story to tell. They simply hold and watch their portfolio fall and wait for conditions to change. Psychologically, this is harder than having something to believe in, even if the something you believe in is not actually working as advertised. There is also a professional dimension worth naming honestly. Many of the people who advise others on investments, financial advisors and brokers, are compensated, directly or indirectly, based on the products they recommend. An index fund, with its tiny expense ratio, generates very little revenue for the person who recommends it compared to an actively managed fund with a higher fee structure, and virtually nothing compared to the commission structures that characterized much of the retail investment advice industry before regulatory changes began to shift the incentive structure. This is not to suggest that all financial advisors are deliberately steering clients toward more expensive products, but the incentive structure creates pressure, and pressure, over time, shapes behavior in ways that are not always fully visible to the people experiencing them. And that helps explain why low-cost index funds took as long as they did to become mainstream, and why certain sectors of the distribution network continue to underrepresent them today. The persistence of active management at scale also reflects, in part, something genuine about its function that the pure indexing argument sometimes underplays. Active managers set prices. They do the research that moves prices toward fair value. They provide liquidity when markets are stressed and other participants want to sell. An economy composed entirely of passive investors would genuinely function differently, and probably worse, than one with a mix of active and passive. The active management industry, despite its general failure to deliver returns to investors net of fees, is not without purpose. The question is not whether active management should exist at all, but whether any given individual investor paying fees for active management is likely to recover those costs through above-market returns. And, on that specific question, the evidence is consistently clear in the direction of no. So, what do we do with all of this in practical terms? The answer, and this might be the least satisfying part of everything we have explored tonight, is that there is no single answer. The economy is not a machine you can tune with a screwdriver. It is billions of people making decisions every day, and the patterns that emerge are real but not fully controllable. What we have done tonight is not give you a strategy. It is give you the words, the framework, the understanding you need to make sense of the headlines, to ask better questions, and to sit with uncertainty without it turning into fear. For the rest, the decisions about what to do with your own resources, that is between you and your own judgment, ideally informed by professionals who understand your specific situation. What we have done tonight is give you something quieter but maybe more lasting, the ability to see the system clearly. And sometimes that is enough. There is one further note worth adding here. Before we let the mind settle towards sleep, the indexing argument, traced across its half-century of development, is in many ways a story about epistemology, about the limits of what any person can know, however smart and however hardworking. The brilliant stock analyst who has done the research is not wrong to think their analysis has value. They may be entirely right that they understand a company better than most other people do. The problem is that in a market full of other brilliant analysts who have also done the research, the edge that any one person's superior understanding provides tends to be thin, expensive to capture, and rapidly competed away. The index fund's claim is not that expertise is worthless, but that in a competitive market, expertise is priced, and the cost of paying for it typically exceeds the return it provides. This is a humbling observation about the limits of intelligence and effort when applied to a domain where everyone else is also applying intelligence and effort to the same information set. It is the observation Cowles arrived at reluctantly in 1933, that Fama formalized theoretically in the 1960s, and that Bogle translated into a product in 1976. 3 generations of very different people, arriving at the same uncomfortable, valuable, and ultimately liberating conclusion: that knowing what you do not know is, in investing, one of the most profitable things you can know. There is a quiet human thread running underneath everything we have covered tonight, worth pulling into the light before we let this rest. John Bogle, who grew up watching his family lose its money in the Depression and spent his career fighting to give ordinary investors a fairer deal, who launched a product the industry called a Folly and lived to see it become one of the most transformative innovations in the history of finance. Alfred Cowles, in the 1930s, trying to find evidence of genuine skill in investment analysis and arriving, reluctantly, at conclusions the industry did not want to hear. Eugene Fama, building the theoretical framework that explained why Cowles had found what he found. Burton Malkiel, writing the book that took those academic insights to the general public at exactly the moment Bogle was looking for the intellectual ammunition to build something new. Warren Buffett, making a public bet that the simplest possible strategy would outperform the most sophisticated, and being proven right within a decade. The millions of ordinary savers who, often without fully understanding the intellectual history behind the decision, chose simplicity over sophistication and captured market returns that eluded many of the professionals who charged for the attempt to do better. Bogle died in January 2019 at the age of 89, having spent his final years continuing to write and speak about the interests of ordinary investors with the same tenacity and the same idealism that had characterized his work for decades. He remained controversial to the end. He was admired by a generation of ordinary investors who attributed genuinely significant portions of their retirement security to the lower costs his products had made available. He was viewed with considerably less warmth by parts of the financial services industry, whose revenues had been compressed by the competitive pressure of the low-cost funds he pioneered. And he was regarded with a mixture of respect and ambivalence by some of his own industry colleagues, who believed the passive investing movement he championed had grown large enough to create problems its originator had not fully anticipated. His legacy is one of those rare cases where the financial impact on ordinary people is genuinely measurable in aggregate. The assets held in low-cost index funds and ETFs, which exist in part because of the competitive pressure Bogle created, have saved ordinary investors something on the order of hundreds of billions of dollars in fees compared to what they would have paid in the world that existed before Vanguard. This is money that stayed in investors' portfolios and compounded over time rather than flowing to fund companies and their managers. Whether this represents Bogle's most important contribution is a matter of perspective. From the standpoint of ordinary people's retirement security, it is difficult to argue it is not. The competitive effect of Vanguard's low-cost approach has also extended well beyond Vanguard's own funds. As index funds grew from a curiosity to a mainstream option, competing fund companies were forced to respond, either by launching their own low-cost index products or by cutting fees on actively managed funds to remain competitive with the passive alternative. This competitive dynamic, driven by the simple presence of a very low-cost alternative in the market, has resulted in overall expense ratios across the mutual fund industry falling dramatically over the decades since Vanguard was founded, a benefit that flows to every investor in every mutual fund, not merely those who chose to index. When Bogle said that he was fighting for ordinary investors, the scope of what he meant included this competitive effect. The way that having a genuinely low-cost option in the market exerted pressure on every other auction to justify its higher cost. The fight was not just about which fund any individual investor chose. It was about what the entire market for investment products looked like and how much of the return ordinary investors got to keep. What is perhaps most worth honoring about Bogle's life, beyond the financial impact, is the consistency of the conviction across 7 decades. The thesis he wrote in 1951 as a Princeton undergraduate and the speeches he was still giving in 2018 argued for the same essential thing, that the investment industry's obligation to ordinary investors was primary, that costs mattered enormously and were systematically underappreciated, and that simplicity, patience, and low costs were not concessions to limitations, but genuine virtues in an uncertain world. He was sometimes wrong about specific predictions. He was sometimes stubborn in ways that his colleagues found frustrating. But on the central question, the one his entire career was organized around, the evidence accumulated over 7 decades has been remarkably consistent in his favor. And in a field where confident predictions routinely turn out to be wrong, and impressive track records regularly prove to be luck rather than skill, that sustained consistency between an argument and the evidence bears noting. You are lying there now, in the dark, perhaps thinking faintly of your own savings, your own retirement account, your own decisions about where to put money you hope will still be there decades from now. There is a particular comfort available in the history we trace tonight, different from the comfort of any specific investment recommendation. It is the comfort of knowing that the intellectual foundation of the simplest, most widely available investment approach was laid by careful, honest researchers who followed their data where it led. Over nearly a century, against the sustained resistance of an industry with every incentive to deny what the data was showing, the indexing case was not assembled by marketing departments or motivated by commercial interest. It was assembled reluctantly by people who would often have preferred to find a different answer, finding instead the same uncomfortable conclusion repeated across different decades, different markets, and different methodological approaches. The index fund will not make you rich quickly. It will not find the next great company before anyone else does. It will not give you a story to tell at a dinner party about the brilliant investment thesis that paid off. What it will do, in theory and in the long run of the evidence, is give you the return of the market at the lowest possible cost, across however many decades you are willing to hold it, which has, historically and on average, been more than most people actually achieved through the attempt to do better. There is a particular kind of patience required to embrace this, a willingness to accept the average as genuinely good enough, which turns out to be considerably harder emotionally than it sounds on paper. The average, in the context of investing, is not the same as ordinary or unremarkable. The average return of the stock market over long periods has been substantial enough to transform small, regular contributions into meaningful financial security for ordinary people with ordinary incomes. The problem is that this average is not smooth. It arrives in volatile, uneven lurches that test the patience of even the most committed long-term investor. And the moments when it tests that patience most severely tend to be exactly the moments when abandoning the strategy feels most compelling. There is also the quiet but important reality that for most people, accumulating wealth is not primarily about outperforming some benchmark. It is about having enough to retire with dignity, having enough to weather an unexpected financial shock without disaster, having enough to pass something on to the people you love. The indexing approach by capturing the full return of the market at the lowest available cost, does not promise extraordinary outcomes. It promises appropriate ones, grounded in the actual long-run performance of productive human enterprise, rather than in the confidence of any particular manager or analyst. For the goal of having enough, this is not a modest promise. It is, in many ways, exactly what most people actually need. This is, in a sense, the final and most important insight of the index fund's intellectual history. The returns are not the hardest part. Capturing the return of the market through an index fund is mechanically remarkably simple. The hardest part is staying invested through the periods when the market is falling and the temptation to sell and wait for things to improve is strongest. Precisely the periods when selling and waiting tends to produce the worst long-term outcomes, as investors who have sold miss the recoveries that follow and end up with less than the market would have given them if they had simply held on. This is the version of the indexing argument that Bogle returned to most insistently in his later years, and the one that the pure mathematical case for low costs somewhat underemphasizes. The mathematics of the expense ratio advantage are compelling and important, but the mathematics of staying invested through a painful decline, of holding an index fund that has fallen 30%, while the financial news is full of expert voices predicting further declines, and the temptation to move to cash is strong, is not a mathematical exercise at all. It is a behavioral one, requiring a faith in the long run that no chart or formula can fully provide. Bogle's contribution was not just to build the product, but to spend decades arguing, publicly and persistently, for the disposition of mind that the product requires to deliver its full benefit. He called it, sometimes, the courage to hold on. It is a more apt description than it might first appear. Research on investor behavior has consistently documented what is sometimes called the behavior gap, the difference between the returns that an investment vehicle earns and the returns that investors in that vehicle actually capture. The gap exists because investors tend to buy after markets have risen, when the returns are visible and confidence is high, and sell after markets have fallen, when the pain is acute and the future seems uncertain. The result is that the average investor's actual experience systematically falls short of the average investment's historical performance, not because the investments were bad, but because the timing of their participation was poor. A study by the research firm Dalbar, conducted annually across multiple decades, has consistently found that the average equity mutual fund investor has earned considerably less than the average equity mutual fund has returned over the same period, a gap attributable almost entirely to poor timing of purchases and sales rather than poor fund selection. An index fund held continuously through good and bad markets captures the full market return. The same index fund bought and sold based on market conditions captures something meaningfully less. Understanding this and building the patience to hold through the difficult periods is the behavioral component of the indexing approach that is harder to communicate and harder to sustain than the intellectual argument for low costs. This is precisely why the simplicity of an index fund, which at first glance seems like a limitation, can actually function as a behavioral advantage. There is less to monitor, less to tinker with, fewer decisions to make, and therefore fewer opportunities to make the timing error that costs so much in the long run.